welcome to today's episode of Hoarding Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Reality is surprisingly persistent, no matter how much imagination I throw at it. The only mystery in life is why the kamikaze pilots wore helmets. We're constructive on the market. I have no idea what that means. I don't think you do, either. This is a strong buy. What do I do with this? Click the mouse harder when placing the order in my brokerage account. If past history was all there was to the game, the richest people would be librarians. Warren Buffett.
This chart tells you everything you need to know about global debt since 2008. China did not just take on more leverage, it lapped everyone else on the track. While the US and the EU crept up modestly, China treated debt to GDP like a high score challenge. A massive stimulus in 2008 sent the line vertical. A 2015 deleveraging attempt lasted about as long as a New Year's resolution. Then COVID came and China doubled down again, pushing past the US and the EU debt levels by 2022. Meanwhile, India is a quiet kid in the corner whose line barely moves. This article is basically a reminder that tracking macro indicators is a financial version of checking the weather. Everyone does it, nobody trusts it, and half the time it still rains on your picnic. Credit growth, inflation, PMI, IIP, consumption, each tells you something, but never the full story. One says accelerate, one says brake, one says turn left, and GDP politely shrugs in the corner. And yet, smart investors track these high frequency levels because they're the closest thing we have to highlights in a very foggy economy. The trick isn't prediction, it's pattern spotting. See the turns before they become headlines and react before the crowd wakes up. Big shifts are happening in global markets, the kind that you only notice after they rearrange your portfolio. First, Japanese 10-year bonds now yield more than S&P 500's dividends for the first time in 25 years. Yes, Japan, the global capital of zero yields, is suddenly paying more than American equities, and that's a plot twist. Second, Chinese 10-year yields have been below US yields for 3 straight years. One economy is slowing, the other is tightening, and both are pretending it's totally fine. And third, central banks are quietly reducing their dollar reserves and boosting euros and gold. Slowly, politely, like they don't want the dollar to take it personally. As Hemingway once said, how did you go bankrupt? 2 ways, gradually and then suddenly. India's markets hasn't just grown, it's reinvented itself. In 2015, large caps were worth about 70 lakh crores, and today they are at 278 lakh crore rupees. Mid caps up 7x, small caps up 9x, basically sprinting past everyone like they missed the memo on gravity. But here's the real twist. The entire market structure moved up a weight class. What counted as a mid cap in 2015 is now barely a small cap. The mid cap cutoff has jumped from 4,000 crores to 33,000 crores today. That's not normal growth, that's market puberty. And the fuel behind it, India's own investors. Demat accounts exploded from 2.5 crores to 19 crores. SIPs pump in nearly 30,000 crores a month. And for the first time ever, DIIs now own more India than FIIs. Here's a fun reminder that when it comes to gold, the US is basically Scrooge McDuck. With 8,133 tons, it has more than Germany and Italy combined. After that, Europe dominates the leaderboard like it's the Olympics of hoarding. Russia and China sit mid-table, stacking steadily but nowhere close to the West's walls. And India, despite its love affair with gold, ranks 8th with 876 tons. That's central bank gold, of course. If we counted Indian households, this chart would need another page and maybe another wall. This chart tells you who really runs the internet. The US sits at the top with 4,165 data centers, which is basically, yes, we store your data and your neighbors' dogs. The UK, Germany, France and China round out the top 5, each with a few hundred centers, respectable but nowhere near America's server empire. Meanwhile, India sits at number 8 with 271 data centers. Not too bad, considering that we jumped in with almost nothing a decade ago to becoming a serious digital hub today. The real message, the new global power isn't oil, gold or land, it's storage. The numbers are in and they're loud. Tier 2 and smaller cities are about to become India's retail growth engine. While Tier 1 grows at a solid 8 to 10%, and rural builds steadily, Tier 2 is sprinting ahead with a projected 12 to 15% CAGR. That's not growth, that's aspiration on steroids. And here's the twist. India's per person retail spend is still a fraction of the US or China, which means the runway ahead isn't long, it's practically infinite. As incomes rise and consumption explodes outside the metros, the next big retail story won't be written in Bombay or Bangalore, but in places most brands have ignored for a decade. Tier 2 India doesn't want good enough anymore, it wants choice, convenience and cool, and it finally has the income to demand it. Nifty 50 earnings just delivered their worst showing in 12 quarters, a tiny 1.2% growth. Meanwhile, the rest of India Incorporated casually showed up with 10.8%. It's like watching the toppers struggle while the backbenchers suddenly start scoring centuries. The Nifty 50 share of total profits has now dropped to a 5-year low of 50%, and the real action is elsewhere. Mid caps grew 77%, small caps blew past them at 37%, and most of the earnings power comes from cyclical sectors, the ones everyone alternatively loves and fears. Big firms aren't collapsing, they're just moving slower. Smaller companies, on the other hand, are in full hustle mode.